Hello. In this video, I'd like to review the Project 3 that is due on June 20th and review it from the perspective of how I'm going to build it for ARRIS International. So the first thing I'm going to do is I'm going to go back and read the instructions. I can see that it's worth 10 points and when it's due. It's going to pull everything together in one document, and that's going to be PowerPoint. And we're going to include the worksheets in the document and attachments. Organization is fairly important. We're going to use the note section for additional information so our slides aren't too crowded. We don't need to use animation, but we're really looking for an easy to follow and logic flow. So the first thing we're going to do is we're going to take everything in Project 1 and Project 2, consolidate it into this document. So I'm suggesting that you actually go back, and if I made comments, which I know I did on most people's, go back and change it, make sure that it's good, and then put it in. You're going to create an analyst report. So now that I have a broad understanding, I actually see that there is an outline of what should be there. First page, title page, company summary, summary cash flow, the summary financial statements, a table, common size and graph, cash flow summary, cash conversion cycle, free cash flow. So we've done all that. So why don't I just go over, and hopefully this is going to work out pretty good, is I know what needs to be there. So if I can set this up just right, yeah, there we go, we can see that there's my title page. Okay, I'm going to go in and change the date so I know which version I'm working on. So I am going to June 2017. I've gone through, I'm talking about the company, okay, everything that was there. So now what I'm going to do is I'm going to add on pages. So the first thing I'm going to do is I got to do something for summary financial statements, but I know I don't want to make them too crowded. So what I'm going to do is I'm going to lay it out plain, blank, and then I'm going to just add another one. And I can do that by duplicating slide. Okay, because I know one is going to be my financial information. So let's just duplicate that. And what I'm going to then do is I'm going to go over to my Excel here. And you can tell I have my summary financial information. So basically all I'm going to do is copy, paste. And as you can see, it doesn't necessarily easy to read, so I'm just going to make it a little bit bigger. And if you want to get fancy, you could change the type a little bit. So I've highlighted it. So what I'm going to do is make it a little bolder and just make the type font a little bit bigger so we can see better. And there we have the first page. So let's put that in the right order. So now I have that. I am going to go back over and I am going to do the same thing with my common size. So I'm going to copy and just bring it right over here. I'm going to paste it in. Obviously I got to make it bigger so that we can see it. And I'm going to once again use Arial Black because it's a heavier one, and I'm going to make the type font a little bigger. So now we got our common size financial statements. So what we've done is we're just taking what's been done and putting it in. So now I want to bring my graphs in. Now my graphs may be a little bit different because when I look, I have some of the data, but what I can do is, let's just, again, I'm going to copy, paste, and there's my graph. Okay, so let's do a new slide. And I'm going to take this one then, because it's the meaningful one for me. And I am going to go put it in this. So what you can see is that I am just cutting and pasting from my Excel, and I'm doing some things to make it look that it reads better. So that's what you want to do. Now that means I'm going to keep going, and I know which end, and I'm going to just set up each of the different pieces so that I can see it. So let's move on. We now have that. Let's see what the next requirement is. And if it would come over here, there we go. Cash flow summary, cash conversion cycle, free cash flow. So what I'm going to do is I'm going to add in a few slides here. And I'm going to go to my Excel. And I'm going to look at my cash flow. And again, I don't know how to get rid of that, but I don't think that's going to copy over. So what I'm going to do is I'm going to copy this. And again, I'm just going to go put it in here. Once again, you can tell that I'm going to try to outline it a little bit here. And we have a picture of what's going on. So there's that one. There's my cash flow. And now I'm going to come right back over here because what I'm looking for is my cash conversion cycle. I'll copy that over. And my working capital. So I'm going to copy those over. I don't have to keep this on. You don't have to watch me do this part. But what I did next was I copied my sales analysis. And I just want to take a moment with you. As you can see, I have the top line. What I've done is put the total numbers. But then I've broken it down into 3 different ways. I got all of this information from the 10K management discussion. So what we can see here is that we look at the different business lines and we can see which ones are growing and what's the major reason for that. We can see that the sales have been both U.S. and international. And we've also seen the large customers, and in this case, they happen to have 3 major customers who account for over half of the company's business. So this is the type of thing we got to go to this level of detail to understand the company. When we look at it from an analysis perspective, so you need to have some level of breakdown here. But then, what do we really know? The first is the increase from 2015 to 16 is the result of increased customer demand for video customer equipment. So I'm being very specific as to what's driving this change. And the top 3 customers, which I previously listed, account for 63% of that. They've also added additional products and customers from the acquisition of Pace Corporation, which contributed to the increase. So now we have a sense of what happened on a very specific basis. The decrease from 14 to 15 was a result of lower video products, and what we're seeing with this, it was a cyclical change based on changes in technology. And overall, technology is changing rapidly and customers are upgrading when it makes economic sense to do, thus creating volatility in sales. So we want to have first a numerical explanation other than the top line, okay, and some narrative at a level of depth. And when you see this, you sometimes need to come up with the numbers to be able to make the observations as to where. Now let's take a look at the next step. The next thing is to review expenses. So what I did is I essentially went back to here and took a look at what's going on. And the first thing I can see here is that the gross margin is going down. So I researched that, and what I found, it declined from 29.5% in 2015 and 14 to 25%. Now that's big. It's the result of the increase in video equipment sales, which, as I noted, went up substantially in sales, and it has a lower margin on that product, and that's what drove it down. I then put in my chart of expenses, and I broke them down into selling and administrative, R&D, amortization of intangibles, integration, and restructuring. Where did I get that? Well, essentially, what I did, and I'm just bringing this over here, this is the 10K, and in the 10K, there's something called the Management's Discussion Analysis. Item 7, I think we've referred to this before, but if you read it, it will tell you what are the key things going on. So all of these questions you should be able to get right from here and relate back to the financial statements. So I put them in, and then I developed a narrative Increase, again, the company made an acquisition. So if the company making an acquisition, it's important to understand what it did. First thing is it increased selling and administrative expenses. Variable compensation went up, and advertising and promotion expenses increased by $3 million. So we know they bought something, they have more ongoing expenses. We looked at R&D. Now, R&D is for the future, and they're in the area of technology, so they're engaging in more R&D to keep technology current and to expand the product portfolio. Then I looked at the one right next to that, and that's amortization of intangibles, integration of restructuring expenses. So when I look, intangibles are a result of a merger, and it's a recurring expense, and we're going to continue to have this expense as they engage in more business combinations. So I know what that is, but I segregated it out. It's not lumped together. Now, integration and restructuring costs, they incurred costs in both 2016 and 15 associated with the acquisition of Payson and 15 Active Vision. These costs include severance pay because they got rid of people, they consolidated functions, they abandoned facilities and there was loss on that, the cost of actually buying the company, and how do they integrate the different systems together, that cost. So long term, they're expenses that we see in the current period, but will make the company more profitable in the future. Interest expense is increased as the company issued debt. So these things, I got all of this right out of here, management discussion. You should be able to do the same thing. Now, what's the next thing it says? It says ratio review. So what I did is I put my ratios in, and sometimes I had to break them down because there's a lot of different things in there. So I broke them into 3 slides so I could see it, but then I came down to what was the biggest thing that's going on with ratios. And what I observed, and I went back and said, what thing is important? And when I'm starting here, let's go back up here. Current ratio, it's pretty much stable. But what I'm seeing is they're turning over the inventory more rapidly, faster. Okay, so you're turning it over more. So that's a positive, but I wanted to know why. So again, I looked at the management discussion and improvements in their supply chain, how fast they can get inventory, and their inventory management of getting having the right level of products and getting them to the customer faster. So we know that's what they've done. The next ones we get into are really debt management, and we're seeing a couple of different things in there as the is becoming much less leveraged. We're seeing that it was very highly leveraged here, but when we've got to the current month, we've seen that it's declined. So that gives us, well, what happened with that? And when we look at it, is the assets of the company have increased as a result of the acquisitions. So what I did is I found out that they made an acquisition of Pace, which was paid for in cash, which reduced the working capital. They issued new debt to pay for that. They issued $800,000 of debt, and they issued common stock. So what they did is they increased equity by issuing stock. At the same time, the acquisition resulted in intangible assets of $1,258,000 in goodwill, and that's what's driving the negative interest. So we look at that and say, okay, now we've gotten that piece. All my questions I've incorporated into the things you've seen already. So the next thing is says here, summarize the consensus sale, earnings per share, and price target. You can use the Wall Street Journal. I've also found that if you go to CNN Money, you'll find it there. You can go to the Wall Street Journal and found it there. And if you go to the Wall Street Journal, you come up and you can find this is the stock target price, earnings per share estimate. We can also go to CNN Money And this one I like for a couple of reasons. One, I find it easier to read. So let's say come down, earnings and sales forecast. We're looking for consensus earnings. Okay, that's earnings per share and sales. So what we're looking at is for the full year. So when I look at the full year 17, the forecast range 238 to 260 with a consensus estimate of 251. So I'm going to put 251 in here. Okay, so they're going to, that's the estimate that the analyst has. When we look at 18, we see the forecast of consensus is 293, but we don't have the full year 2019. So what I did is I went back over to annual, and what I found is that the Wall Street Journal has the 3 years, and that's 321. So what we can see is that it is increasing over time. So now the sales forecast. I found the sales forecast on CNN Money. Okay, so what we can see for the sales forecast, sales, is the sales forecast. So what it's telling us here is consensus estimate of 6.7 billion. So I'll put that in. And what are they looking at for 2018? So I go right over here to 18, and I can see that the estimate is $7 billion. So what we're seeing is we're seeing an increase in sales. So we've gotten that from two places: CNN Money, Wall Street Journal. Next question asks you right here, what's the price target? And what I did, just to flip back over here for you, is stock price forecast. So what it's telling us is there's 8 analysts watching it, and all I did was copy this, which is the chart, put it in here, which is telling me here's the historical price, and what we're seeing is low to high with a medium of 33.50. So that is that section. So what I did is, here's the future, consensus earnings for 3 years, the sales forecast for 2, and a forecast of stock price. This is what the financial markets and the analysts are thinking is going to happen with this company. The last thing we're asked for is a conclusion on the company and the future. So what I said is I looked at it and said it's a technology company that has a specific market niche, equipment. It's building market share and supply chain. The acquisitions the company have made contribute to that, and they're buying 2 more companies is going to provide for future growth. The other thing that the company has an opportunity is in LTE and 5G. We've all been through 3G, 4G, and now moving into 5G. The company has a positive cash flow, as we've seen, and a very strong balance sheet. Major risk to the company is the ability to get, they have these intangibles, and the ability to turn them into income is the risk. Overall, I think it's a good story, and I'd rate the company as a buy. So that's what's required in Project 3. I am putting out there this video. I'll also put out the copy of the PowerPoint, and I'll put out my Excel worksheet for you. Please let me know if you have any questions, and we look forward to reading your final presentation on June 20th. Thank you.